In this video, I will be looking at the stocks that Superinvestors have been buying in the previous quarter. Superinvestors are popular investors who manage funds, and this website shows what they've been buying and selling in the previous quarter. So that is Q4 of 2024. I will be looking at the most common purchases they've been making, but of course we'll only be looking at the permissible stocks from a halalness perspective. These are deemed permissible because they are compliant on Zoya at the time of this recording. Zoya is a stock screening app that allows you to see if a company is compliant or not to invest in. Another stock screening app is Musafa, so do check them out for more information and their stock screening process. Also, these buys were released for the previous quarter, so that's Q4. There are still many top names who have yet to submit their buys, as they will have different reporting dates. So do let me know if you want me to make a video when those are released, so I can make a part 2. Also, Q4 covers the last 3 months in 2024, so any buys or sells in 2025 will not show. I will also be looking at specific investors such as Warren Buffett to see what his fund has been buying. If you do like these types of videos, then hit the like button and also subscribe to the channel for more content like this. To see these stocks, I've just jumped into my stock valuation spreadsheet. This basically shows an overview of some of the key metrics of the company, but it also looks at their technicals, dividend information and their most recent earnings reports as well. And there's also analyst information. But the main feature of this spreadsheet is to value a company using these different valuation techniques. And if you did want access to this spreadsheet, then just check the link in the description. The biggest company on the list in terms of the most buys was Ferguson Enterprises Inc. So the biggest one was actually Microsoft, but that is questionable on the Zoya app. So I just wanted to include, for the purpose of this video, just companies that are compliant. This was the company with the most buys in the most previous quarter. So this actually surprised me because I don't actually know too much about this company, but just looking at their website, I believe they provide products and services for different industries. So these are some of the industries that they serve. So it does look like an interesting company, but I will just have a quick look at some of their key metrics. So analysts currently have this as a hold, but they do have a higher price target than what is the current price. And in terms of their financials, the revenue has grown over the past 5 years, over 6%. However, I think the revenue has been sort of stabilizing in the most recent years after looking at their financial statements. So always do check out their financial statements, and if you do want me to do a more in-depth analysis, then do let me know in the comments below and I can do a proper review of the company and also a valuation as well. And we can see the profit margin is also quite low. It's at 5%. So usually I like to see this around 20%, but I do believe that this may be a different type of industry. So I'd have to look at other competitors in the industry to see what their sort of profit margins are and their key metrics. So this one does look fairly decent. A PE ratio of 22. So usually I like to see around 20, but 22 seems somewhat reasonable. The current ratio is 1.68, so that's fairly good. It means it's got a lot more assets than liabilities, and its long-term debt to equity is below 1 as well. And just looking at its price to free cash flow, it's about 30 or just under 30, so it's 27.9. So I'd obviously have to do a discounted cash flow valuation to see if it is undervalued, but just looking at this, it does seem to be around or slightly above fair value. So that would be interesting to do a valuation on that. And its return on assets, equity and investments have all been in the double digits. Looking at its technicals, it's down 18% from its 52-week high. So maybe that's why investors are investing in the company, because it seems to be in a dip range, or it it is slightly discounted, and they do pay out a dividend as well. It has a small yield of 1.31% with a payout ratio of 37%, so that's a manageable dividend payout ratio, and maybe that will grow over time. But just looking at the beta, it is above 1. So 1 is basically the market, and anything above 1 means it's more volatile than the market. So it's interesting to see that. And the earnings, in terms of their earnings, their revenue over the past quarter did increase by a very small amount, and their earnings per share has actually decreased. So that could be some of the reason why the stock has been selling off. But year to date, it is up over 6%. The next company on the buy list is Taiwan Semiconductors. This is a semiconductor company, is obviously part of the craze recently as this sector has really been picking up lately. The analysts also have this as a buy and a price target of $249, which is much higher than the current price. But one thing about analyst ratings is that they do sometimes suffer from recency bias. So if a industry or a company is hot in the market, then they will usually sort of push up their recommendations or their price target. So that's always one thing to consider, and that's why I've got this valuation section here, so you can value the company for yourself. Its revenue has grown over 5 years 22%, which is very impressive, and the profit margin is really high. So I do like to usually see 20, but this is 40%. So tech companies do tend to have higher profit margins, and also semiconductor companies. So that's usually why there's a lot of hype around them, because their financials are usually really good. And looking at its PE ratio, it does seem quite low, to be honest, for a company of this sort of growth. So that could potentially mean that it is undervalued, and maybe the analysts are correct in saying that it is a buy. But obviously, again, you'd have to do a valuation to determine that. And then we've got the current ratio, which is really impressive. So that's 2.44. So if it's above 1, that's usually considered decent or good, but this is above 2, which means it's got more than enough assets to cover its liabilities. And then the long-term debt to equity is well below 1, so that's 0.22, and the price to free cash flow is 36, and all the return on assets, return on equity, and return on investments are all well in the double digits. And from its technical perspective, it's down just over 10% from its 52-week high, but it is up over 65% from its 52-week low. So it does seem to have gone on a surge, but it does seem to have cooled off a bit. And the beta is 1.12, so it's just slightly more volatile than the market. It also pays out a dividend as well, and it has a dividend yield of 1.14% with a payout ratio of just under 30%. So there's plenty of room for that to grow. And then earnings, it seems to be good across the board. There was a slight decline in its surprise. They were expecting slightly higher in terms of earnings per share, so it was a slight reduction from that. But overall, the revenue and earnings per share have grown significantly, and year to date it's up over 3%. So it's not as high as Ferguson was. So maybe it could be that the semiconductor industry is starting to cool off a bit. So we've seen down from its 52-week high, and maybe there's just less interest in semiconductors at the moment, but that could change. And then you've got over a whole year, just look at that graph, it's gone really high. I believe the reason why this company is not the most purchased one, as in it's behind Ferguson, is because of the international risk. So there's always going to be risk in that area of the market. So Taiwan, China, any of those kind of companies will have that foreign risk. For example, if there's tensions with the US or something, then obviously that will impact the company and even the share price as well. The next company on the buy list is Uber. This is a company that is actually already on my watch list, and it is a company that has recently been purchased by Bill Ackman. So Bill Ackman is a popular super investor. He's mostly known for his big investments in Laos and I believe Netflix as well. But he's made a post on X which did go sort of viral, and he explained why he was investing in Uber. He has given a bit of information here, and he did say that he will provide more update on his thinking of the company shortly as well. So I'm not sure if there's been an update since this was only around a few weeks ago. Analysts do have this as a buy with a price target of 89, and the revenue over the past 5 years has grown over 30%, and it has a really healthy profit margin of 22%. Its PE ratio is 17, which to me looks like it's really undervalued, and its current ratio is above 1, which is good to see, and its long-term debt to equity is also well below 1, so that's also good to see. And just looking at its price to free cash flow, we can see it does look like it's undervalued, as it's sort of in the low 20s range at 24.25, and all the return on assets are in the double digits. But what is really impressive is the return on equity, which is up over 60%. And just looking at its technicals, it does seem to have gone up quite a lot over the past 52 weeks. So it's up over 44% from its 52-week lows, and it's down 8% from its 52-week high. So again, a slight sell-off, but it does seem to have gone on a huge run. So the question really is if the company is still undervalued after going up this amount. And the beta is above 1, so it's 1.42, so it is more volatile than the market, and it doesn't pay out any dividends at the moment, and it may do in the future, I'm not sure, but at the moment it doesn't pay out any dividends. And then the earnings, just looking at the earnings, they're really impressive. So the revenue surprise was up by 1.72%, but the earnings per share surprise was up a whopping 546%, and its revenue quarter on quarter has grown over 20%, and its earnings per share quarter on quarter has gone up over 377%, which is really impressive. And year to date is up over 30%, so that's just in the last 2 months. The next top company that has been bought by these funds is Estee Lauder, which I believe is a beauty company. It does show as compliant on Zoya, but I'm not too sure as it's in the beauty industry. The next company is Eli Lilly and Co. This is a healthcare company, and looking at its financials, we can see that the revenue has grown over 15% over the past 5 years, which is quite impressive. So I just wanted to compare that to Johnson & Johnson just to see how that compared. So you can see another similar company in the same industry has just moved up 2%, whereas Eli Lilly has gone up over 15%, and it has a healthy profit margin of 23%, which I believe is quite good for a healthcare company. And looking at its key metrics, the PE ratio does seem to be quite high, but obviously you would have to do a valuation to see if it is undervalued or not. But analysts do currently have it as a hold as a price target of 1,000, whereas the current price is just short of that. And then the current ratio is above 1, so that's good to see. The long-term debt to equity is 2, so that is quite high. So you'd have to look as to see why that is quite high. But what I like to see is debt to equity being below 1. And then the price to free cash flow does seem quite high as well. So that's 572. So that could potentially be overvalued. But again, you'd have to do your discounted cash flow to see how accurate that is. And then you've got your return on assets, 12%, return on equity, which has been quite impressive, 65%, and then return on investment, which is also fairly good as well, so that's 24%. And just looking at its technicals, we can see that it is down 13% from its 52-week high, and it's up over 18% from its 52-week low, and its beta is well below 1, so it's not as volatile as the market. It also does pay a dividend as well. It is a small yield at the moment, and the payout ratio is 44%, which is decent enough for room for growth. And then in terms of their earnings, we can see that their revenue has increased quarter on quarter 44%, which is really impressive for a healthcare company. And then you have your earnings per share quarter on quarter has increased over 100%, which again is really good. So this is probably what has attracted investors to it due to their good earnings. And year to date it is up over 9%. I have noticed other healthcare companies like Johnson & Johnson have also been doing good this year after a fairly poor year last year. So you can see Johnson & Johnson up over 7% as well, which is just another similar company in the industry. You can see that the healthcare sector is sort of being favored at the moment. And if we look at the 365-day chart, it does seem to have gone on a huge surge. The next big buy by investors is Lam Research Corporation, which I believe provides some equipment and services to the semiconductor industry. So there's been 2 semiconductor companies on this list, and the other one was obviously Taiwan Semiconductors. So it seems like investors have still been buying these semiconductor companies. But again, this was in the previous quarter, end of Q4. Lam Research is still doing fairly well, to be honest, compared to Taiwan. I believe the issue with Taiwan is mainly the foreign risk. But if we just look at the finances, we can see that the revenue has grown over the past 5 years over 10%, and the profit margins are fairly healthy at 26%. The PE ratio is 25, so I believe that was slightly less than Taiwan Semiconductor, which is quite low for this sort of industry, so it could potentially be undervalued, but obviously you'd have to do a valuation to find that out. And then the current ratio is really high, so that's really good to see. That's the good thing about tech companies. They generally have a lot more assets than liabilities, so they can usually easily cover their liabilities. But this is 2.54, which means that it can more than cover its liabilities. And the long-term debt to equity is below 1, so that's obviously good to see. And the price to free cash flow is 26%. So again, from a cash flow perspective, it could also be potentially undervalued. But again, that's something that you'd have to do yourself using the discounted cash flow valuation. And then we've got return on assets, equity and investments all well into the double digits, especially the return on equity that's up 50%, which is really impressive. And from a technical perspective, it seems to be sort of in the middle as to where it was over the past year, in the sense that from its 52-week high it's down 26%, but then it's up 20% from its 52-week low, and its beta is 1.5, so it's more volatile than the market. But that is generally the case for semiconductor companies, and it also does pay a dividend. So this seems to have quite a high yield of 7.8%. If I check that, if that's accurate, dividend yield is 1.1 on Google, so I'm not sure how that's been calculated. I'll have a look at that figure to verify that. And then the payout ratio is 27%, and the earnings are also quite impressive as well. So revenue quarter on quarter is up 16%, and the earnings per share quarter over quarter is 27%. And year to date it's up 14%, and over the past 1 year it does look like it's really surged up a lot. And then one more company I wanted to look at was Intuit. This is another one that's been purchased by the Superinvestors, and this is basically the owner of QuickBooks and TurboTax, as well as MailChimp as well. So QuickBooks is a popular accounting software for small medium enterprises, and it's really good accounting software that is at an affordable price for small to medium-sized businesses, and it's also used for a lot of self-employed people as well. They use this to upload invoices to their accountant, and then the accountant uses it as well to prepare returns and financial statements from that information. Its revenue is up over 19% over the past 5 years, which is quite impressive, and it also has a fairly decent profit margin of 17%, and its PE ratio does seem quite high, and then the current ratio is over 1, which is good, and the long-term debt to equity is well below 1, so that's 0.34, and the price to free cash flow is at around 31, but you'd obviously have to do a discounted cash flow valuation to see if that is undervalued. And return on assets is just under 10%, and then you've got return on equity and return on investment both in the double digits. The analysts currently have this as a hold rating with some potential upside, and from a technical perspective this does look quite attractive because it's down over 17% from its 52-week high, and it's up 5% from its 52-week low, so it does seem to be reversing a bit, but this is usually a good point to start looking at the company once its share price has dropped. And the beta is 1.28, which means it's more volatile than the market. It also does pay out a small dividend as well. It's only a small amount of 0.66%, and it has a payout ratio of 34%, but I do believe it grows its dividend over time, so that yield should grow. In terms of their earnings, their revenue quarter over quarter has increased over 10%, and their earnings per share quarter over quarter has declined by over 18%. However, the EPS surprise was still positive, so it beat expectations, and year to date it is down over 6%. It hasn't been performing too well this year, and over the last year or so it does look like it is quite high, the price, but I think this was around 2021 or 2022, so it seems to be sort of around those levels where it previously was. I know this video's been going on for quite a while, so I just wanted to show one more company which is not one of the top companies investors have been buying, but it is a company that Warren Buffett has been buying. So he's obviously a famous investor who has a very impressive track record. So we can see in Q4 he's purchased this company. So this is Pool Corporation, and they are involved in the pool industry, so they provide pool equipment, services and fittings for that industry, and you can see they've added quite a lot of this company to their portfolio. In terms of the overall portfolio, it's only changed it by 0.03%, but they did also purchase it in the previous quarter as well, in Q3. That was their first initial purchase, and I did also have this company on my watch list. So just looking at this company from its financials, over the past 5 years it's gone up over 15%, and its profit margin is quite low at around 8%. However, its PE ratio is also quite low. It's not that low as some of the other semiconductor companies which have a lot more growth, such as Lam Research and Taiwan. The current ratio is very good as well, so that's well above 1 and also above 2, which means it can more than cover its liabilities just from its assets. And the price to free cash flow also looks quite attractive. So again, you'd have to do a discounted cash flow valuation to see how fairly valued it actually is, but that does look like it is discounted, or at least around fair value, just from a cash flow perspective. And the return on assets, return on equity and return on investments are all in the double digits. And from a technical perspective, it has gone up a lot from its 52-week low, so it's up 17%, but it's also down a lot from its 52-week high of over 18%, and the beta is just over 1, so that's slightly more volatile than the market. And in terms of dividends, it does pay out a dividend. It's got a small yield of 1.37% and a payout ratio of 32%. In terms of its earnings, revenue quarter over quarter was a slight decline of 2%, and earnings per share was also a slight decline of around 6%, but they were both above expectations. And the upcoming earnings, I believe, is on February the 20th, so that's coming up soon. And year to date, it's only gone up or just around 1%, so it hasn't really moved much over the past 2 months. And over a 360-day time frame, we can see that it's really surged up a lot. I hope you enjoyed that video. Please let me know if you would like to see a part 2 when the next Super Investors purchases are revealed, or if you would like to see more covered in this video. If you did make it this far, then I would really appreciate if you could hit the like button and also subscribe to the channel.